G'day investors. Federal Treasurer Jim Chalmers just dropped the 2026 budget, and it features massive changes to your taxes. The headline act? The classic 50% capital gains tax discount is being completely axed for future gains. Starting July 1st, 2027, the system is shifting back to an inflation-adjusted indexation model. This means instead of halving your taxable profit, the government adjusts your asset's original purchase price for inflation. You will only pay tax on your real profit above inflation, which sounds fair, but changes the math. Alongside indexation, Chalmers is introducing a strict new 30% minimum tax floor on all net capital gains. If your regular income tax rate is lower than 30%, your investment gains will still be hit at this higher floor. These changes hit everyday assets across the board: Aussie shares, exchange-traded funds, crypto, and investment properties. But take a deep breath. Your principal place of residence, the family home, remains entirely exempt from CGT. If you love property investing, there is a massive twist to help boost Australia's struggling housing supply. But beware if you buy existing, established houses. You are locked firmly into the new inflation-adjusted model. Furthermore, negative gearing has been heavily restricted for established properties bought after budget night, May 12th, 2026. Rental losses on those properties can now only offset rental income or capital gains, not your salary. So, what happens to the shares or properties you already own right now in 2026? Don't panic. The government has introduced transitional arrangements to protect your current, hard-earned profits. Any capital gains your assets accumulate before July 1st, 2027 still qualify for the 50% discount. Only the growth that happens after that line in the sand will be taxed under the new indexation rules. This gives everyday investors a clear runway of just over a year to review their financial portfolios. If you are using a discretionary family trust to hold investments, the rules are getting even tighter. From July 2028, discretionary trusts face a flat 30% minimum tax on all taxable income. This completely blocks the old strategy of splitting investment income with family members in lower tax brackets. For tech workers and startup employees, employee share schemes and options will also lose the 50% discount. This major structural shift means long-term investment strategies across Australia must be completely re-evaluated. High inflation environments might actually favour indexation, but low inflation years will mean paying significantly more tax. For everyday stock investors, tracking your exact portfolio cost base over time is about to become highly complex. You will need to calculate precise quarterly consumer price index adjustments every single time you sell shares. Remember, these major overhauls still need to clear federal parliament before officially becoming law. It is absolutely vital to chat with a registered Australian accountant before making any sudden portfolio changes. Smash that subscribe button for more clear Aussie wealth updates, and we will see you next time.